CBN raises interest rates to 15.5% to fight inflation. Bank of England delays bond sales, launches temporary purchase program after market turmoil. Stocks hit 2020 lows as fears of recession build. Plus, China's offshore currency hits record low against dollar. This is Business Express on the network service of the NTA, and we're reaching you from Abuja, the nation's capital. I am Benny Adams, your guide. Good to have you join us at this time, and it is that time we talk business. I will start by telling you that Nigeria's apex bank, the Central Bank of Nigeria, may witness a major restructuring as Senate is considering a bill that seeks to separate the office of the Governor of the Central Bank of Nigeria from that of the Chairman of the bank's board. National Assembly correspondent in Excuse, Unko, tells us more.
It was a busy order paper at Tuesday's plenary. The Central Bank of Nigeria Act Amendment Bill was considered. The Governor of the Central Bank of Nigeria is also the chairman of the bank's board, but the bill, sponsored by Senator Sadiq Umar, is seeking to separate the two offices. A number of senators did not agree with the bill and called for its withdrawal, but the sponsor remained unyielding.
To divest the board of the powers of determining and fixing the salaries and allowances of its members. And 3, to consider and approve the annual budget of the bank, which lies solely with the National Assembly.
That we shall really allow this bill to go for public hearing. We'll get more information and then they will be properly convinced. But I've given them enough reason to believe that this bill should be allowed to go for second reading.
You can check. Any governor of the central bank is both the chairman of the bank and the chief executive. From Federal Reserve Bank to Bank of China.
I would recommend that this thing be stepped down so that we'll be given step down so we can have more materials, to be able to make an informed judgment.
Those in favor that this bill be now read a second time, say aye. Those against, say nay. The ayes have it.
From the National Assembly, Ignatius Nkwo.
Meanwhile, the Central Bank of Nigeria's Monetary Policy Committee has, for the third time in a row, hiked rates in a bid to tame inflation that has risen above 20%. Leah Katumbabatunde reports that the committee also took a decision to raise credit reserve ratio to 32.5% as the campaign season begins.
It was as visible as it could be. For Governor of the Central Bank of Nigeria, Godwin Emefiele, lowering rates was not an option for the Monetary Policy Committee. The global and domestic environment are caught up in difficult circumstances with the possibility of a global recession staring authorities in the face. So, a tight policy stance to consolidate on the last two hikes was taken. 150 basis points brings the monetary policy rate to 15.5%, while credit reserve ratio was also tightened with a 48 hours marching order for banks to comply.
We are going to take liquidity out of the vaults by Thursday. If any bank fails to meet up with this expectation, the decision of the MPC is that we may need to preclude those banks from foreign exchange market on Friday and onwards until they meet this 32.5.
In easing the pressure on forex demand, the governor says commercial airlines should source through their banks, as no law makes it compulsory for foreign airlines to buy dollars directly from the central bank.
When you give Nigerian airlines opportunity to land in your country, they pay people who are traveling using these airlines will pay naira. If they pay naira, they will not come to the central bank or any bank to say they want to remit ticket sales. I have to be selfish to defend my country, ladies and gentlemen. The only thing they will go to their banks or by extension go to the CBN to say they need will be dollars to import planes or dollars to import spares or pay for their insurance, which is significantly lower than if they were to remit the entire ticket sales.
Despite a cloudy outlook, the bank says it is committed to protecting the economy without losing sight of the spending that comes with elections. Firstly, to put a leash on inflation and then spur growth, particularly in the non-oil sector, as it has been doing through its various interventions. In Abuja, Leah Katumbabatunde.
Still talking MPC, this is the highest rise since 2006, but then it is targeted at reining in inflation, which is presently at 20.52% and also at the highest level 17 years, with cash reserve ratio at 32.5%. The 48 hours marching order to banks is ticking, and yes, indeed it is one more day to go. Uche Walike is a professor of capital market with Nasarawa State University. He is here to give an insight to the implications of the latest change on the economy. Prof, you're welcome to Business Express.
Thank you very much, Benny.
Well, highest rise in 17 years. Yes, inflation is the reason. Possibly there are some other reasons, but did you see this coming, and what's the possible implication on the economy?
Thanks, Benny. I did see it coming.
Okay.
Yes.
You really did.
Yes, it was.
Okay. Reasons.
Yes, it was quite expected. You mentioned it. Rising inflation. Inflation happens to be the major reason why the central bank, the MPs of the central bank, took that decision. So I knew that the MPC, would hike rates, but what I didn't see coming is the fact that it was raised by as much as 150 basis points. Yes, I was actually expecting at max maybe 100. Yes, but not as much as 150 basis points. And again, the MPC also came, with a double blow. Not only increasing the MPR,
but the cash reserve ratio. The
cash reserve ratio was also increased from 27.5%. To 32.5, 500 basis points. So for me, that's really squeezing. This central bank is now really out to squeeze liquidity, from the system. And as I said earlier on,
but Prof, yes. Sorry to cut you. Squeezing liquidity.
Yes.
Do we feel this in our pocket?
Yes,
we don't seem to see this liquidity.
Yes.
We're talking about the common man on the streets, and then we're talking about mopping it up. How is that happening?
Yes.
Can you break it down so that we get to understand this?
As a matter of fact, traditionally speaking, monetary policy is actually the link between what the central bank is doing and then aggregate demand. Okay. Trying to ensure that money supply, the money in circulation, is controlled. Okay, so what the central bank is targeting is the one that flows through the banks. Of course, you know that this economy is hugely dominated by the informal sector. So small business, a lot of money is actually circulating outside. Okay, which is also why I think that raising the MPR or trying to control inflation through any of the channels, okay, whether the interest rate channel, credit channel, even exchange rate channel, or the assets, the wealth channel, may not really work. The transmission mechanism will always be affected by what I just told you now, that a lot of money is outside the the banking system. So the central bank is targeting the one that is in the banking system, that flows through the banking system, which is why it says now the reserve, cash reserve ratio, we are increasing it. So the deposits you are going to do now with us will be higher to constrain their ability to lend. So that's under the credit channel. The central bank is also saying that we are raising the benchmark rate. Okay, it also means that it will also translate to increase in lending by the banks. Banks will automatically increase lending rates. So of course it has implications, but the major reason I see the central bank doing this, MPC doing this, is to in their own argument, tame inflation, and more importantly to also tame the pressure on the exchange rates. You see what is happening globally. Central banks, especially in developed economies, are increasing rates. The US Federal Reserve not long ago increased the benchmark rate, they call it the Fed fund rate, by 75 basis points. In the UK, the Bank of England also increased by 50 basis points. So as they increase in the US, what happens is that interest rates in the US, go up. Okay, the dollar too tries to strengthen. So you now find that investors, because interest rate is going up in the US, investors are leaving emerging economies, frontier economies, to the US. And those in the US that maybe want to also come to Nigeria to invest won't come because the returns in the US are already high. So central bank is trying to tame capital outflows from Nigeria and also see how they can attract inflows to Nigeria by also raising our own rates, to appear competitive, so to say. So again, central bank thinks that if the money in the circulation is less, there will be less pressure. People will have less naira to go and start buying foreign exchange.
But Prof, was there room for another option? I'm asking at this because usually not just the Nigerian economy and African economy, but the global economy is still recovering from the effects of the COVID. Yes, we had a lot of disruptions, talking about a trade, exchange, and all of that. So it was expected, will I say, the common economics, from my understanding, is okay, let's have more money flow, we have more production, manufacturing, let's have sufficiency in-house, then we'll get to possibly do exports to strengthen also our currency. Then while we're talking about recovery, inflation came in, the war in Ukraine got its own effects and all of that. We are also saying the civil servant will say, okay, the economy is not enough. Yet CBN is there's so much money in circulation. But also, yet we can't grab that one out there, but it is the one that is moving from bank to bank.
But
was there an option?
But when communicators said that they didn't even consider a hold position, maintaining the status quo, that they didn't even consider reducing the MPR.
It had to go up.
Yes, that all of them agreed that it should go up. So, but if I were a member of the MPC, I wouldn't, maybe I would have been a dissenting voice, tilting more towards the argument you were making. Yes, we have seen the economy beginning to grow. First quarter we had 3.1, second quarter 3.54, but it is still tepid. The growth is still not strong. Okay, and I was thinking that the central bank could have held the rates, maintain the status quo, given the fact that it was only May that it increased by 100 basis points. And in July, okay, it also it increased, 150 basis points, 100 basis points, so far. So I was hoping that the central bank would have allowed that, to permeate through the economy before coming up with an increase. But again, as I said, that they would increase. I had expected it, but the quantum of the increase is again what I think is much, particularly so when they have also increased the cash reserve ratio. The banks are going to have difficulty now, with their liquidity. Interest rates certainly are going to go up. That will have it will impact negatively, you can be sure, on cost of capital. A lot of firms will no longer be able to borrow money because interest rates production will slow down. And already, even by central bank's own admission, the purchasing managers index has dropped below the 50 points threshold, and that means that is a signal that manufacturing activity is already contracting. So my bet, Benny, I can put down some money on it, that the real GDP growth rate for the third quarter of 2022 will slow down. Will drop. It will slow down, partly on account of what has happened. There's no doubt about that. As I said, businesses will now have difficulty accessing money. Even the government will also have more difficulty now borrowing money, or rather they will now borrow money at a higher cost. So cost of borrowing on the part of the government will go up. The cost of servicing debts, the implication will also go up. And for my constituency, the stock market, you can also expect that.
I was to ask. I think the stock immediately responded negatively to it. Was that a coincidence?
No.
And possibly with this reaction by the capital market, what should we expect in the coming days?
Yes, what you saw, yesterday in terms of stock performance, is only a continuation. The market has actually anticipated that and has been reflecting that on stock prices, and that's why you find that for the week the market has been down, negative return, because people are already anticipating that the MPC will raise rates. And usually when rates go up, what happens? People begin to sell. You have a lot of sell pressure. Investor sentiment become dampened, so they keep moving money from equities to fixed income, where rates are beginning to go up. And you also find that all across asset classes, we hear now that most commodity prices are going down because interest rates are going up, and so people will want to put their money, sell those assets and then put their money in a fixed income. So it's going to come. It has a lot of consequences. Of course, you have the merits and the merits of it.
But it seems that the merits seems to be more.
Yes, but for an economy like ours, that still needs to be, stimulated or propped up. I think we should be careful the rate at which we move up interest rates. We wouldn't be moving up interest rates because other countries are doing so. But I understand too, partly why they have done that. Again, the central bank feels that this is an election. We are entering an election year.
I was
so
actually
they also want to mop up this liquidity so that it doesn't get into the hands of politicians.
I want to bet you he's already there. I'm not sure. But the major driver for this decision is inflation.
And forex exchange rate.
Forex. I'm going to come to exchange rates too. What if it doesn't work?
Yes. Do you know why it may not work as the central bank expects? Recall that there was a raise in May, there was a raise in July, and now they're raising. And what has happened since May, when they have been raising rates, inflation rate has been going up. Today we are talking about 20.52%. So why that may not really materialize is obvious.
And the exchange rates too?
Yes. Do you know why it will materialize? That's what I'm getting to that. Because of the major drivers of inflation. Inflation rates today in the country is not caused by, they are not monetary factors. Not caused by too much money really chasing too few goods. That's not the issue. Even check the National Bureau of Statistics reports on inflation. It's clear there. The major drivers of inflation, what are they? High cost of fuel, high cost of diesel, which of course fits into high cost of transport. You have hike in electricity tariff. You have
data tariff.
Yes, no, even the government borrowing. The government borrowing to do subsidy on fuel because we import petroleum products. So you now find that this cost push nature of inflation, it will not allow the central bank transmission mechanism to function. Look at insecurity, for example. Insecurity preventing people from going to farms. And remember too that the major pressure of inflation we're having today in this country is on food. So the central bank cannot solve that problem by trying to remove money from the circulation. The best way to solve it is to increase food output by dealing with insecurity, and ensuring that we stop importing petroleum products. That's price of these products.
I feel, Prof, even all of these suggestions will not feel the immediate impact.
Yes, and let me also say this. It's also important that the central bank doesn't keep increasing this at every meeting, in order not to create panic. Because people are already saying now the central bank is panicking. If the central bank is saying we'll increase rates so that you will not have money to go and buy forex, okay, and people get the impression that central bank is panicking, what is the expectation? Expectation now will now be that this thing will go up. So instead of you now pulling back, okay, because central bank thinks you will pull back, the rational thing for you to do, you go and buy more. You want to go and speculate now and buy more because you think the central bank is panicking that rates will also go up the next meeting. Prof, do you understand what I'm saying?
I just hope we keep talking about this.
So this panic, inflationary expectation,
for lack of time,
very, very important.
I think we will continue this conversation. We'll continue this conversation. Thank you so very much, Professor Uche Walike, for sharing this deep thoughts with us at this particular point in time.
Thank you.
Thank you. Well, moving on, the Independent Corrupt Practices and Other Related Offences Commission, ICPC, has taken its anti-corruption campaign to another level, this time involving traditional religious leaders to champion behavioral change initiatives in their various domains to assist the Commission expose corrupt practices shredded in constituency projects, especially in rural communities. This was at the sensitization dialogue held in Abuja.
Because of corruption and greed, we have afflicted ourselves with many sorrows, and we have deterred the rate of our development in our nation.
We need a change in behavior, a change in attitude, a change in direction.
Law and order is important, but if people don't change their attitude, it will be much more difficult for us to get the change that all of us are talking about.
Oil prices fell more than 1% on Wednesday, pressured by a strengthening dollar and crude storage bills that offset support from U.S. production cuts caused by hurricane. Brent crude futures fell $1.02 to $85.25 per barrel, while U.S. West Texas Intermediate crude futures were down 97 cents at $77.53 per barrel. Both contracts had risen above 2% in the previous session. Well, let's now see how the Naira is changing at the official central bank rate. Stocks gained Wednesday at the close of trade, although marginally. The 0.02% rise is an indication that the decision of the MPC is permeating. The oil share index closed at 47,171.7 points. Deals were 3,981, volume 101 million, while value of trade was 1.197 billion naira. Equity capitalization ended the session at 26.5 trillion naira. GT.Co, Zenith Bank, and FBN Holdings were the most active stocks. And on the global market, shares sank 2-year lows on Wednesday as surging borrowing costs and a worsening energy crisis intensified fears that the world could tip into recession, which sent investors dashing for the safe haven. For more on global markets activities, I have Bosede Abel joining me.
Hello and welcome to the Global Market Review. European stocks were sharply lower on Wednesday as global markets sold off on economic concerns surrounding inflation and the growth outlook. DAX, FTSE and CAC were all in red. Now in Asia, Hong Kong stocks led sharp losses in Asia-Pacific markets after the S&P 500 set a new 2002 low overnight on Wall Street. The off-share and on-share Chinese yuan reached weakest levels since 2008, and the Indian rupee also marked a record low. Hong Kong Hang Seng Index dropped 3 0.41% at 17,250.88. The Shanghai Composite also dipped 1.58% at 3,045.07, and the Nikkei 225 fell more than 2% at section lows but closed 1.50% lower at 26,173.98. Stocks in the US fell Wednesday as traders struggled to find their footing after the S&P 500 nudged a fresh bear market low in the previous session. Futures tied to the Dow Jones Industrial Average dipped 0.29%. The S&P 500 and Nasdaq Composite also on the red. It also wasn't a good trading day for most African stocks, with stocks in the red except for Tunisia's Tunidex, which posted a 0.40% gain to close at 8,337.10. That's the Global Market Review. I am Boss Sede Abel.
And that wraps Business Express for today. Join us again tomorrow by 9:30 a.m. for another fresh edition.